All right, everybody. Once again, welcome to the Cash Flow Empire every Tuesday night at 7 p.m., where we bring amazing people here, experienced operators, experienced passive investors, and just all the above, just to really bring a lot of value to everybody. And because we know what it's like to just kind of, feel unmotivated. We all get unmotivated sometimes. So we love bringing these every Tuesday. So, I mean, technically, it's still the beginning of the week. So we get to get inspired and just keep killing it throughout our week and finish our week off strong. So today we have a very special guest of ours. Her name is Prolet. Prolet, how are you doing today?
I'm good.
Welcome, welcome, welcome. And I'm super excited. I don't know. How are you feeling tonight? You feeling okay?
I'm good. I was gonna say thank you for having me. And it's I am honored to be sandwiched between all of those great guests. It's amazing.
Awesome, awesome. And just to kind of get this call started today, let us know who Prolet is. By the way, I love your name. Where you from?
I'm from Bulgaria, and actually my first slide is a little bit about me. So just let me know when you want me to start.
Let's go ahead. Let's pull the trigger. We're ready to go.
Okay, well, I don't know what is the composition of the audience, but I am a passive investor. And what I'm going to share today with you is a little bit about my path from tech to financial independence through real estate. And I'm going to share quite a few numbers. At any point, if you guys have any questions, let me know. But my goal here today is to tell you a little bit about me, go a little bit through a couple of terms to make sure that everyone is on the same page when I am mentioning them, and then dive into what is my portfolio allocation, kind of like what are my asset diversification, and a little bit more from my perspective why I invest in real estate. So without further ado, I don't think I put that in the about me slide, but yes, I am from Bulgaria, but I have been now here in the United States for over 20 years. So this is my hometown. Now, about me, for 20 plus years, I was in business intelligence, engineering, and design. I helped companies like Leapfrog, Autodesk, and DocuSign bring products to life. However, that was very much in the corporate world. And in the meantime, I actually started investing a lot in alternative assets. And at this point, I have been in 25 plus alternative asset deals. I'm going to show you a little bit more later what that composition is. But in my spare time, I enjoy traveling, hanging out with my husband and my cats. You can see some of the pictures from my most recent travels. I love going and exploring different countries. And I have cat tags at the end, just so you guys don't feel bad if you don't see my cats yet. I love real estate. I've loved real estate for a long time, and I feel very fortunate to be able to actually use real estate to get into my financial independence. As part of my now extended sabbatical, I left my job from the corporate world last year, but I have found a company, Well Cindy, which is really focused on the products for passive investors that help them track their real estate portfolios. Now, before I dive into the real numbers and everything else, I want to talk a little bit about financial independence, or FIRE. I'm not sure how many of you have heard about the FIRE movement, but when I initially started on my path, I hadn't heard about the FIRE movement. Fortunately, now there's a lot more resources, but FIRE stands for Financial Independence, Retire Early. I put retire early in parentheses because it's not necessary for everyone to go and retire early. You don't have to. If you enjoy your job, go and do it. But really, the financial independence gives you a lot more freedom and power in everyday life. Now, from FIRE perspective, there are 4 general types of FIRE that people refer to: lean, regular FIRE, chubby FIRE, and fat FIRE. And those are really described by the amount that you can live off of. And therefore the amount you need to have invested in order to live off that for a certain period of time. So Lean Fire is 40K draw and basically 1 million invested. All of this is based on something called the 4% rule, which basically pretty much guarantees you success in not depleting your or not going to zero with your portfolio for 30 years. Normal is 40 to 100K, chubby is 100 to 200K with a 2.5 to 5 million invested, and Fed is above 200K. Now, I encourage you to go and research a little bit more, read about FIRE, and calculate your FIRE number. I included 2 FIRE calculators that are generally available. The first one is the most popular one. The second one, I recently found out, and it's really, really detailed. So highly encourage you, go and try it out, find your FIRE number, and just at least have in mind, where do you need to get from wealth accumulation perspective in order to live comfortably and be able to have that financial independence. I'm gonna have a couple of slides later to kind of show you though how having investments in real estate makes this slightly different, because this is usually all based on investing in stocks only. So the second term that I want to make sure that everyone is on the same page, although you guys are here, so you probably have heard a lot already about syndications, what they are. I just wanted to make sure that we're leveling set what a real estate syndication is. And syndication really is a way for people to group and pool money together in order to invest in a larger asset. Now, what distinguishes syndication from a JV or joint venture really is the fact that you have 2 sides. One is the limited partner and the other one is the sponsor or general partner. I am a limited partner, and anyone that knows me, I always say, I don't want to be a general partner. That's too much work. Really, limited partner is awesome. You give money to people and then get money back. It's great. So even if you're in the general partner side, I'm hoping that your goal eventually is to get to the limited partner side, where you also have the time to spend your time however you want. So those 2 things, I just wanted to level set. Now, let's dive a little bit into my path and how I started. Now, my career started a little bit earlier than 2004, but I started this map a little bit from when I first invested in real estate. And my first investment was really my first primary home. That was in 2004. This is where I saw, hey, you know what, this is like really great. I'm not paying rent. I'm actually building equity. I'm kind of moving forward. So I decided that, hey, I will do this. I will invest more in real estate. I will dive into more rentals. And around 2010, I bought 2 other houses with the idea of renting them out. At that point, they were cash flowing. I had good tenants for that time. So I was all inspired, all excited. I was like, yes, I'm going to go and I'm going to buy X number of houses with $100 to $200 cash flow a door. This is how many houses I'll need to get in order to get to financial independence. And back in 2010 to 2014, there were not really that many resources. Now there's so many great resources like this meetup and like all these other great places on the internet. You can learn about real estate investing, where you can learn about syndications. Back in those days, syndication was not really so widely spread out. And one day, I think I was browsing the Bigger Pockets forums, and I came across syndication, and a light bulb went on. And I was like, oh my God, who in their right mind will want to invest in hundreds of single-family homes instead of just going to multifamily? Now, because also at that point, there was not as much information around syndications, one thing that I really, really made upset about is that I really didn't know about the possibilities of doing syndication as a non-accredited investor, things like 506B versus 506C syndications. I was not really as aware of it. So for me, I started investing in multifamily as a passive investor when I became an accredited investor. And my only regret is that I didn't really go and learn more so I can start investing in 506B syndication earlier. If I did that, I would have become financial independent much sooner than I am right now. So in 2017 is when I became a accredited investor. I started investing in syndications. My first investments were in multifamily. And my only other single family investment was my current primary home, but that's it. For me, no more single family investments, only syndications. Now, that's background. Let's dive in already. What does my portfolio look like? And I really decided to be really upfront and show people this. I have not really seen that many passive investors really share their portfolio allocations. It's always been really, I have been curious. So I figured I'll show you guys. My last job for the last 10 years was in analytics. So that's why I was saying we're going to see a lot of numbers. We're going to see a bunch of graphs, and we're going to dive in. So first, we're going to start from my top level of allocation. And I'm going to preface with, I believe in diversification. I do not believe that everyone should be 100% a stock or 100% in alternatives. There should be a balance. What your balance is up to you to answer. For me right now, I am at about 58% alternatives and 42% stock. Again, stock has some advantages. It's liquid, it's there. It also is a good hedge just to say that, hey, you know what? There might be ups and downs in all industry or all assets. So having diversification is important. But again, for me, majority of my allocation is in alternatives. Now, when I say alternatives, real estate definitely is one of the alternatives, but let's take a look further from the alternatives. How are those separated? Right now, I'm still primarily in real estate syndications. That's about 72% of my portfolio, so pretty large chunks. I also still have a rental that's out there. It's making money, and I have good tenants. If I get bad tenants, maybe I'll change this, but for now, it's going okay. I also started investing in oil. I mean, I'm in Texas now. I'm in Austin. When you're in Texas, you're supposed to do oil, or so I heard. So I started doing oil primarily from tax perspective. For those of you who are on W-2s, I highly encourage you to take a look at the tax advantages of oil, especially from active income offsetting. It worked for me. Does it work? I don't know yet. From tax perspective, it worked. From investment perspective, ask me in a year once I actually have consistent income from oil. I also have some crypto, not doing so great, and I have one angel investment that I have with me. Now, why so much in real estate? And I'm gonna give you 5 reasons that why I invest in real estate. First, for me, it's better returns than the stock market. I tried the individual stocks thing, it didn't work. I now have mostly brought the funds, so they're just sitting there, so I have the market diversification. But really for me, especially after I started getting my distributions from my syndications, I really realized the power of having investments in real estate. Now, I would say for those of you who have not invested yet or haven't gotten new distributions yet, sometimes it's hard to think of it from passive investor perspective, like, oh my God, is this going to work? Is this not going to work? But once you start seeing the returns, it becomes much, much easier. And once you start getting some of the investments going full cycle, it gets even easier. The next part is the tax-free cash flow. Consult your CPA, but generally, when you are investing in the real estate or real estate syndications, you will have enough depreciation for the cash flow that you're generating each year that your cash flow for that point is tax-free. It's a little bit more like tax deferred because at the end you have a bunch of recapture on this, blah, blah, blah. But when you're getting the money, it's tax-free and you're not taxed. So you're deferring the taxes for later. And $1 today is worth more than the $1 tomorrow. So it's always good to kind of hedge that. The third part is tax advantage returns. Real estate usually has better tax treatment because it's long-term capital gain. But further, once you start investing in real estate, you will actually realize that you continue to invest in real estate. And as you invest in more real estate, usually when you have one syndication coming to full cycle and giving you returns, you would have enough other depreciation pushed forward that you don't actually have to pay taxes on those returns at that point, and they're again pushed forward in the future years. So it's amazing. Again, consult your CPAs, but for me, so far that has worked. I have had 7 deals go full cycle, and we're going to talk about this in a moment, but I don't actually have any tax liabilities yet for those because I have enough depreciation to offset them for future. Now, the fourth item, which is really, really important for me as a passive investor, is that all of this is passive. I don't have to deal with tenants on my rental. Like literally a month ago, I had a branch fall and break the fence, and I had to deal with it. I don't have to deal with that when I invest in a syndication with somebody else. The general partner or the sponsor is the one dealing with all those troubles. And I just kind of like make sure that I'm on top of what's happening and know that they're handling it. But that's all. I don't have to call anyone for repairs. Now, the fifth item, and they're not necessarily in any order, but the fifth item is really the ability to diversify. I talked about diversification between stocks and real estate, but also you can diversify within real estate. Now you can diversify by sponsor and project, you can diversify by location, and you can diversify by asset type. Now, let's take an example. You have $100,000 to invest, and you go and buy one single family home, maybe 2. If you're lucky. With the prices going up, you probably have to be very lucky. But that's 1 or 2 assets. 1 or 2 assets that are basically 1 or 2 tenants that if one goes and doesn't pay rent or one has to be evicted, your returns are probably gone. But with syndications, take those 100,000, split it in 2. 50,000, 50,000. You can choose to invest in Texas and invest in South Carolina, or you can choose to invest in multifamily and storage, or you can choose to invest with 2 different sponsors, right? You can diversify and limit your risk by basically going out and having that diversification. Now, I realized when I initially started investing in multifamily that I do want that diversification. So let's take a look a little bit more into how my real estate syndication portfolio is diversified. So I'm still primarily in multifamily, but I'm about 60% in multifamily. I am 19% in industrial, 6% in RV, 6% in retail, and 4% each in medical and hospitality. That is something that I'm still working on. I had storage, it went full cycle, so I don't have storage anymore. I want to bring in storage back. But I like different things about each of these asset types. Okay, that's all good in theory. And I don't know how many of you have invested. Oh, Jonathan has a question. Go ahead.
Yes. I love the diversification part that you mentioned in everything. And I love that. Actually, I personally do that. I like to diversify. I love real estate, so I try to use different vehicles in the same industry. But my question is about, are those numbers changing for you as soon as, I don't want to make it sound bad, but as soon as you get older? Because, you know, maybe older people want to be more conservative because, you know, just like that. So what do you think about that?
Yeah, so again, let's say that I get further down my financial independence path
Okay.
instead of
I love
older.
that.
How about that?
I love that.
I still say I always turn 30, so I'm good.
Good.
But so over the years, it definitely has changed some, but I think that what has changed more is now my focus is a little bit more on cash flowing assets. I honestly have a few development deals that hopefully are wrapping up. And when they wrap up and they go full cycle, I am probably not likely to invest in development deals again, because now I'm at my phase where I live on my distributions. If I was still in the wealth building stage, I might still diversify and continue with some of the other types that basically don't have those distributions. But because, I mean, some development deals grow much faster. Like when you're talking about regular deals in value add are, you know, doubling money in 5 years. When you go into development, that time frame is compressed. So definitely my specific kind of outlook has changed. But if I was still on just wealth accumulation, probably would not have changed.
Awesome. Thank you.
Great. So let's look at how my investments have done so far. Before I go to the slide, though, I will preface with a lot of my investments went full cycle last year before interest rates went up. It was an amazing time to sell. What my results were, I do not assume currently my results will continue to be. And I'll talk a little bit more about my assumptions for how I'm looking forward to what am I expecting in the future. So with that, so far I have had 7 full cycle deals. My total multiplier on my investments was 1.95, so basically 2x. And my average length of investment was 2.8 years. But I usually hate averages, and it was too few deals for median. So that's why I decided to also add that my maximum length was 4 years and the minimum length was 1.2 years for an investment. Now, again, I don't expect that to happen, especially that 2.8 years average. I really am not expecting in the next 5 to 7 years, maybe once the markets recover, but right now that's not what I'm expecting. Now, what does that mean from the other usual metrics that you guys will see usually in your offerings? So that translated to a 28% IRR. And 24% AAR, which is weighted for the investment amount. Now, also, I decided to add what are my maximum return and my minimum return. My maximum return was 48% AAR. It was amazing. And I really don't know if I'll ever have a deal that, again, returns that for me. Like that's 48% average annual return. It's crazy. Now, I also had one deal that returned 1% a year. And the only thing I'm happy about is that, first of all, they made something. And second, I didn't lose my money. So don't expect all of your deals to perform like each other. You will have some really great successes. You will have some not so great successes. And the biggest part is make sure you diversify to ensure that you don't put all of your eggs in one basket. Also, just a note, for the deals that I had go full cycle, they were mostly kind of value add. So for them, I had a 5% average year 1 cash flow. That was after stabilization. So basically usually value add will start distributing 6 months after they're acquired at least. So the 1 year is basically like month 6 to 18. Now, what does that mean to you though? How do you take some of this and how do you apply it for yourself? Now, one thing, and this is part, and the project I'm working on is not complete, but I decided to create this, what I call the syndication investment calculator. So people out there can go and play with it and try it out and test it, and at least visualize for themselves what investing in syndication can look like in a long term. And I'll show you in a moment visualization from that, but you can go put your numbers in, test it out. So I decided to go conservative, and I take few assumptions. So annual distribution of 5%, project length of 5 years, and multiple of 2. That is kind of like right now pretty normal. It's kind of between 5 to 7 years, mainly because interest rates are really wreaking havoc on everyone's returns. But I decided to go with average project length in 5 years, multiple of 2. And now the third part is distribution reinvestment. So when I was in my wealth building phase, and if you are in your wealth building phase, I'm really hoping that when you're getting those distributions, you don't go and just buy a car. You go and you take your distributions, you save them up, and you reinvest them. Sure, go ahead and treat yourself to a dinner or something, not too extravagant, but just feel good that you made money, but still don't just go and spend it. So we're assuming that we're reinvesting distributions, but there is a minimum. So you need to save $25,000 in order to actually invest. With syndications, you have minimums of investment. And honestly, anything below 25K, it's not even worth the hassle because of taxes and K1s, and it's crazy. So I just put 25,000. I think one other thing that I assumed is you are contributing an extra $10,000 a year. So let's take a look at the simulation. And this is a screenshot directly from the calculator. You can go put your numbers in, play with it. So if you invested $100,000, you reinvested your distributions and contributed only $10,000 more a year. By the last quarter of year 15, you would have had total invested of $950,000. And at the end of that quarter, you will actually be getting about $276,000 in proceeds of sale. So this is assuming that like whatever deals you had, they came back, and now you have those extra $275,000 to invest. You would have quarterly distributions of $11,000, which basically is around $47,500 annualized. And in this whole 15 years, you really would have only contributed $240,000. That's your initial $100,000 plus $10,000 additional a year, and then reinvesting the distributions. But your out-of-pocket money is $240,000 for basically $1.2 million invested in year 16. I don't know how many of you have actually gone and calculated those numbers for you. I know that many people don't, and that's why I created the calculator, because even for myself, I wanted to see that. I wanted to be able to go and play with the numbers and see what happens. Now, that kind of equates at about IRR of 16%. That's typical. You will see in a lot of offerings, like that 16 to 18% IRR, and AAR of 20%, because obviously doing your yearly 5 years 2x. Now, in the meantime, if you've invested that same amount, 100,000 and 10,000 each year in the S&P 500, by the end, you would only have $825,000. And that's basically with the average return of S&P 500, which has been 11.1% in the last 30 years. So amazing, right? Syndications are awesome, just like it says in my calculator. Now, let me tell you a little about, for me, how I feel real estate has changed my fire path and how it can change yours. First of all, you really can have a higher draw without reducing your principal. And I'm gonna give you an example in a moment of exactly that, living off of your real estate portfolio, not living off of your stocks. Like with stocks, remember the calculations for fire is 4% rule. But with real estate, you can actually have a higher draw. And that is something that a lot of the fire calculators that are out there cannot really take into account. This is something you need to sit down and calculate for yourself. The other thing is less volatility. We've all seen how the stock have been going up and down in the last few years. Now, keep in mind that a moment the stock falls by 30%, you would usually think like, oh, I just need to rise 30% and then I'm good. But no, if a stock falls by 30%, that stock needs to now rise by 43% in order to get to its old level. So you almost have to double your money in order to get on the same level as it was before the stock fell. So that volatility is really something that you cannot really predict in the stock market. And sure, there are some years where it's great, and then there are some years where it's really crappy. I can say crappy, right? Okay. So let me give you an example of living off of your real estate investment. So, oh, did somebody have a note? Oh, I saw some drawing on screen. Or question again, if you guys have questions at any point, let me know. I'm not monitoring the chat. So Jonathan and Sergio, if you see anything that needs immediate attention, let me know. Otherwise, I'm gonna do Q&A at the end. I only have a couple of more slides.
Everybody's just showing a lot of love and just you got it, girl. Keep going.
Good. Okay. So we are past our accumulation phase. We've determined that we need 1 million. Hopefully you also have some money in stock market, but we're going with 1 million invested. Again, 5% distributions, 5 years, 2x return, except that this time we're not reinvesting our distributions. We're living off of that. So that and all of these distributions, not proceeds on sale, just distributions. All of these distributions we're living off of. All the proceeds on sale, which usually will be like 60 to 70% of the overall return you guys get at the end of the deal, those get reinvested. So you're just living off of the distributions. To make the things equal between real estate and S&P 500, we're also assuming that we're taking money out of the S&P 500 if the dividends that the S&P 500 is providing us, which is 1.6% a year right now, are not enough to basically equate the same amount we're taking out from syndications. So year one, what happens? We invested 1 million. At the end of the year, we still have 1 million because you have 5 years to get your money back. In real estate, we're getting about 50K of distribution, right? That's 5% return. In the S&P 500, we're a little bit over 1 million by the end of the year, but we only get about 17,000 in dividends. And we need to take out of the S&P 500 extra 33,000 in order to equal that 50,000 and be equal. So year one, hey, things are okay. Now year 6, and I took year 6, mainly I didn't want to go into full disclosures on year 5 because year 5 is complicated. Your investment goes full cycle and all this other stuff. Anyway, your investment could go full cycle, you've reinvested. So now you have 1.75 million that is in real estate syndications, which brings your distribution a year at around 87.5. That's 50% more distributions in 6 years after your initial investment. In the S&P 500, in the meantime, you're 1.42 million with 23,000 of dividends, and you need to start taking 65,000 almost out in order to equate the same distribution you'll have from real estate. Now, by year 11, we're not even going 15, 16, we're just 3 examples. You are in 3 million invested in syndications in real estate, and your distributions are 153,000 a year. You can see how exponentially this grows. And again, your portfolio is growing. Your portfolio is also growing in the S&P 500, but you can see at a much, much slower pace. The portfolio is in the S&P is at 1.75 million. And that's mainly because in order for us to live off of our investment, we're depleting our portfolio. And if you continue this trend, actually in about year 14 or 15 is when the S&P portfolio actually starts depleting instead of growing, where your real estate portfolio is not. So it's awesome, right? Okay, let me tell you the bad news. I can't all be just roses and happiness. Okay, few things that you need to be aware about real estate. It's not always fun. You can have distribution pause. I currently have 3 investments that have pause distributions. You also can have capital calls. I have not had any capital calls, no knock on wood, but there are a lot of people that are getting capital calls. So make sure that you do your research and evaluation well before you start investing. And worse, you might get your property to be foreclosed and then you might lose your full investment. So just keep in mind all of this, diversify. With that, if you have 1 million invested, I really hope that you didn't invest that 1 million in one investment. That 1 million should be invested in a lot more different investments just to have that diversity. And then if something goes into foreclosure, it maybe affects like 5% of your portfolio, right? And that's really not that bad. You can probably handle it if some of your deals overperform. So before I really dive into Q&A, I'm going to leave you with 3 recommendations going from here. The first one, skip slide. The first one is learn. If you are a passive investor, the best book I recommend to everyone, and I recommend this book also for active investors because it really should show you what a passive investor expects, is The Hands-Off Investor by Brian Burke. It's an amazing book. It's a little bit more focused on multifamily, but it covers actually commercial real estate pretty well. It talks through everything, PPMs, evaluation, everything. So go and learn. If you want to play with my calculator, I'll put a link. I see that it's a link in the slide that doesn't really help, but I can put the link in the chat. It's completely free. I'm not trying to sell you guys anything. I just want to make sure that as a passive investor, you can visualize what it can look for you. And third is invest. Really, as I mentioned before, my only regret is that I did not start investing early on when I could have learned about 506Bs and actually not have to be on a credit and just be a sophisticated investor and go and invest. But really invest early. Every single person will tell you, every single person who started in real estate will tell you they really wish they started earlier. So with that, this is how you can contact me. And I promised you cat tax. These are my 3 cats. They luckily really enjoy each other, so I don't have crazy fights too often. So I will take any questions and go for it.
That was amazing. First of all, congratulations, Prolet, on all that you've done, on all your investments in general. Just because I think you're the first speaker that we had on here to really get into depth and to educate us on the passive investment side, especially because we're really trained how to be operators. We want to be operators, we want to be involved, but in our reality, I know from my point of view, coming from a you know, being a first generation Mexican American, as I like to say, we weren't taught, or I wasn't taught how to invest. I wasn't taught that, and I kid you not, it wasn't until this year where I literally sat down with my partner, Jonathan. I was like, dude, like, how am I going to be free? How am I going to be free? How am I going to make some money where it's passively and I don't have to put in the time for money? And that's when I realized, like, you know what, I got to invest $1 million. That's when you start to say, you know what am I going to go do? What kind of hustles am I going to get in to go make $1 million to invest into real estate or to diversify my portfolio, right? Just as you're saying. So I think it's extremely important. And I really appreciate you coming out tonight and just explaining the importance of that, because I'm sure my brain's not the only one that went, you know, and I'm sure everybody's going to be motivated to come out and be like, you know what, how am I going to go make $1 million in the next couple of years so that I can set up my future family up, you know, because those are amazing returns. So just once again, thank you so much. And we really appreciate you. And I'm going to let Helen go ahead and ask her question.
Hi, everyone. Hi, Prolet. I really appreciate that you're here and sharing that information with us, because like Sergio said, like no one has shown us those numbers. Like, and that comparison with the stock market was fantastic. It's like you can really see where your money is going, you know, and that is, oh my God, I'm amazed. Thank you so much. And well, my question is about like for the new people who is just starting and they are just trying to figure it out, how are they going to create wealth? How they, people have a job or people has a hustle or business, stuff like that, but they really want to start investing in real estate. What will be your advice? Like, for example, if someone have $50,000, $100,000, they are just starting. How can they start, or how would you do it if you will do it again with this knowledge that you have already?
So if I had 100,000 to invest, and that's the only 100,000 that I had, and I wanted to be passive, because I mean, in a lot of cases, if you have 100,000 and you have the determination, it might be better for you to go and try and be more active, right? And go and do more. But first of all, I would not put all of 100,000 in just real estate. But if I also had some other investments and all of that, I would probably take a chunk of it and invest. And yes, I said that for me, like I was giving an example of a 50K, because honestly, taxes get complicated once you have too many K ones, but I would actually take 25K chunks. And when you first start investing with syndicators, I think it's perfectly reasonable, even if they have a higher minimum, to ask like, hey, I want to test you out. Would you lower your minimum sum? Because like, I want to try it out and see what it goes. In most of my investments with syndicators, I have usually put in the minimum or less than a minimum initially to test them out. And then after that, when I saw that they are performing and they're actually delivering, I reinvested. I definitely, once you find a good sponsor, you go and reinvest because it's easier. You don't have to go through the vetting process all over again. But I would really encourage people to go and take chunks and do 2 or 3 25K investments and kind of go from there. So they have that diversification. So even the worst happens and one of them loses the money, it's not your full portfolio. Okay. So that is my recommendation. But also really think also becoming an active investor if you have the time.
Awesome. Thank you so much.
That was a great question, Helen. What's up, Chuy Arreola? What's up, brother? Step on up.
Good, brother. Hey, well, yeah, I appreciate this, brother. This has been really awesome. I've been wanting to hear the LP perspective for a while. But so my question was, how do you go about vetting a team?
So first thing is yes, you should first vet a team and not necessarily a deal, because most of the times it's the sponsor that makes the deal work, not necessarily the deal. A bad sponsor can ruin a great deal, and a good sponsor can save a really bad deal. So yes, definitely vet the sponsor. Some of my favorite thing is actually to hear other passive investors' perspective. So if you're a passive investor, try to grow your network, try to kind of have somebody you can go and ask and be like, hey, did you invest? Or ask the sponsor, hey, do you have some references for me so I can talk with some of the other passive investors? But then go through and ask questions. So Brian Burke in his book actually has a whole list of questions to ask syndicators, but things around their experience, deals that have gone full cycle, what has gone right, what has gone wrong, what is their investment philosophy, what is their kind of investment focus, and diving in deeper, their experience. And I totally understand that some syndicators are usually a mix of more experienced and less experienced, because everyone has to start somebody, but do kind of make sure that there is at least somebody who is experienced so they can go and really run the project. So really, really dive in deeper and ask them any questions. For me, also, you guys, if you're the active people, you should try and understand my investment philosophy or what I need. Like that person that only has 100K, if I was a syndicator, I would probably not take their full 100K. Right, for me as an active person, it would be responsible to just take everyone's full livelihood. So that would be something really having that back and forth, understanding that from passive perspective also, it's not just a one-way street, it's a two-way interview, right? You guys should be interviewing me as a passive investor, and I should be interviewing you as an active investor, because we need to make sure that we match our investment philosophy and our investment needs match. That was long-winded, but I'm not sure if that helped.
No, that was awesome. Thank you. That's what I needed to hear.
Great question, man. And man, Prolet, you're killing it tonight. I love it. Thank you for coming again. And Lygia, step on up.
Hello. Hi, Prolet. Thank you so much for all the detailed information. Very good education. My question is, how long did it take you to vet your first, syndicators? Sorry, I think it's going to be 3 questions. What were like the key things that made you choose that first indicator? And the third question is, when a property goes into foreclosure, what are the chances of the passive investors getting paid?
Okay, let me start with your first 2 and bundle them together. Okay, as I mentioned, when I started, there was not that much information, right? So I would not recommend any passive investor, unless they're willing to lose their money, do what I did initially, because there was nothing, there were no books. I think there was one like mini tiny book, which I still have in my library, that came about syndications, and it was not really that great. But really what I did in the beginning is I went and I had conversations with a bunch of sponsors. But part of it was they were active in the communities, like some of them were active on Bigger Pockets, some of them were active in the physical communities in the area where I was at. So I kind of made sure that I had some exposure to them, but ultimately I kind of just threw minimums at all of them and tried them out. I also tried out things like CrowdStreet. Just to note, all of my direct investments have performed better than my CrowdStreet investments. So I don't know if I'll recommend CrowdStreet, but CrowdStreet was great for variety and for a good way to just look at PPMs and look at what people are offering. So when I first started, it was a little bit more, yes, I went through some homework, but knowing what I know now, I'm like, oh my God, what the hell was I doing? So I would highly recommend for people now, learn and read. There is a lot more content. You guys are bringing up a lot of content and a lot of other speakers. The book I recommended is great. So try and learn a little bit more than me. Your other questions about the foreclosure, I really hope it doesn't happen to anyone, but there have been already a few foreclosures that were widely publicized. And really the chances of anyone get any of their money back are usually 0. The banks are not going to be very interested in selling for market rate or whatever to make up any money that are beyond what they have basically loaned on the property. So chances of you getting money is almost 0.
Thank you.
Shirley?
Great. Thank you.
Amazing answers, Prolet. Shirley Baez, what's up, girl? How you doing?
I'm good.
Good to see you on here 2 days in a row. I see you.
I know, man. I got the learning juices going.
Let's go.
Thank you, Prolet. This was amazing because I can relate to your journey as well. You mentioned that you had funds on CrowdStreet. So, and I have funds on Fundrise, and of course we all start kind of small, start there. So how were you able to get it out of there without getting hammered? And then can you, the second question is, can you kind of walk us through a little bit about how you utilize the traditional fund, like the S&P 500, to invest in multifamily, because that's kind of where I'm at right now too.
Okay. So for CrowdStreet, CrowdStreet, I think, works a little bit different than Fundrise. So that's one of the reasons I didn't invest with Fundrise. With CrowdStreet, it's similar to choosing other syndicators. There is an offering that is a particular syndicator, and you go through a standard PPM process with that syndicator and you have invested. There's, by the way, some drama on CrowdStreet right now. There's one syndicator that basically like misappropriate funds and all that. Luckily, I have not invested with them, but it's basically the same thing. If one of your investments goes, it's because of that syndicator and that deal, not necessarily because of CrowdStreet or what else, because you are encouraged to, again, vet the investment, read your PPM, like analyze it with any other syndication that you're investing with. So from that perspective, it's slightly different, I think, than fundraise and how you invest in fundraise. Now, your second question around investing in real estate. Again, no endorsement and no recommendation, and I'm not giving financial advice. But I personally am a little bit more risky investors than other people. So I will completely fess up to actually doing margin loans against my stock portfolio and investing that in real estate. So I have done that. I keep it at a low percentage of my overall portfolio because you're always in danger of margin calls. So be very, very, very careful with borrowing against your stock portfolio, but it is possible. I usually am going through interactive brokers. They have the lowest margin loan rates of all the brokers that are out there, although their customer service sucks.
Gotcha. Okay. Thank you so much.
I see Sergio has a question. Do you have a question, Sergio?
I do have a question.
Go ahead, man.
My question is, damn, my bad. My voice is kind of scratchy, so it cracks here and there. But my question is, for somebody that's here in the group, I'm going to speak for all of us. I'm going to ask a question for all of us. Coming tonight really just kind of changed my mindset even more than it was already changing about investing. Now I really want to invest more to be financially free. Is there any advice that you would give us on how we can just start kind of taking that angle or taking that road, just start mapping that road out to possibly get to $1 million, assuming we still have our 9-to-5, we still work for corporate America. Any advice on how we can just start shooting that direction after tonight?
So I'm going to go to my early investment for accumulation phase. So really, if you have 100K and you invest it now, and you only can add another 10K a year, you would be at that million two in 15 years. Which if you are 25 or 30 years old, that puts you in 45, right? So that's why I'm saying to people, start early. The other thing that I want to point out is, although it's a little bit more complicated, but IRAs and self-directed IRAs and solo 401ks are a thing, and you can actually invest with self-directed IRAs or solo 401ks in real estate. So just keep that in mind, educate yourself a little bit more, because a lot of people say like, oh, I have no savings or no money. And then they're like, oh, but I've been contributing to my IRA for the last 15 years. So I do have money in there. So there are venues. So I would really recommend you evaluate kind of what is your current place. The other thing I would recommend, although his investment advice is not really great, but I think that philosophy is good. Well, not really great for me. I invest in real estate. The person I'll recommend doesn't really invest in real estate. He's very much like invest in funds and be done. But there is a book which is very oriented towards like I would call millennials and kind of the Gen Z, I guess now. It's Ramit Sethi. It's called I Will Teach You to Be Rich. But he has a very good philosophy around savings, but savings where you're not just like pinching every penny. So saving and living your life at the same time. I agree with that philosophy. So I would highly recommend you guys read the book. He has a new edition that's out. He has an amazing podcast that is honestly couples therapy for money. It's very entertaining. So if you're couples, go ahead and listen to it, because it's really, really interesting to kind of see, okay, these are my faults and these are your faults. But really, if you're young enough, some of the FIRE movement would go and say like, oh, like, don't buy lattes, or like, don't go out and eat ever. It's like, save every single penny. And really, I think it's more about trying to be balanced, having savings, evaluating how much savings you have, and actually getting the ball rolling. Because you can, again, if you start with 100K and basically adding 10K a year, in 15 years, you will be at 1.2.
That's amazing. That's amazing, guys. All we need is 100K. And I think we can go find 100K in about a year or two. So that's great to know. So before we wrap up the recording and the call, we do have one more question. I don't see nobody's hands up, but I did get mi tocayo Sergio Aguilar. If you want to come up on stage and ask your question, brother.
Yes, ma'am. Good afternoon. Thank you for your information. What about the ones we got already? Everything. I got a lot of money invested in real estate, and the problem I got is everything is paid for, and I don't know how to do it. I already got more than 1.1, 1.6 in asset and equities, or probably more. I'm making numbers, and I think it's 2.3.
So when you all paid out, meaning that you own the real estate free and clear?
Yes. So I've been doing it without knowing what I'm doing. I don't know if it makes sense, but I keep buying it. And the weird thing is, I didn't know, I don't have any magic formula. I just keep buying one house a year or twice a year, or depends of the last 2008. Sergio and Jonathan knows about it, and I'm eager to invest, but I'm kind of, I don't know if I'm scared or refi, but I'm seeing right here, whenever you say a meal, I already got more than
First of all, congratulations. It's amazing that you had the foresight to actually start doing that, because I mean, 2009, 10 were great years to invest. So good for you. There are some people that really, they believe that that's enough for them, meaning that you have it all that was bought and free and clear. If you're getting enough cash flow to live off of after your expenses and everything else, like, you can continue to do that. If you want to not bother with it, there's multiple options. Yes, you can go and try to refi and take money out and invest in other more passive assets. You can also think about a 1031 exchange, or the other option, which, 1031 into a syndication is usually a little bit more complicated. There's only few sponsors that I know that are doing it, but there are some that are doing it as DST, or Delaware Statutory Trust. But for that, they usually require you to invest something like $500,000, because the paperwork and the legal structures around 1031 into a syndication is different. So you have two options: either refi, take money out. Obviously, you still ensure that your properties are cash flowing after all of the expenses and CapEx reserves, or think about, hey, do you want to continue to take care of their houses, or do you want to go and do something like a 1031 into syndication or larger property? You might be, if you want to do one, you can do a smaller multifamily and buy it yourself if you want to be more active.
Well, that's what I got my guardian angel, Jonathan. We met it, a month ago or 2 months ago, and he opened up my mind into the multifamily. So it's just like I'm reading and reading and reading. So I try to educate myself in what I did right, and then what can I do better. And with the numbers you just put in, it's just amazing.
Yeah. So calculate your return on investment based on your current value, and see what is your basically value to return. Because at some point, your cash on cash return is probably amazing because you bought those houses and they have appreciated. But if you don't have enough cash flow now to live off of, that's a different problem. And that's
No,
what
I
people-
do. I do.
Congratulations. So why do you want, I mean, then I would ask you, like, why do you want to complicate your life and go to more investments? Or do you want to, again, make this decision and yes, maybe go to multifamily completely and not worry about, I don't know, like 20 or 30 single family homes that have 20 or 30 roofs?
Well, the thing is, it's a funny story because I used to be a maintenance man for apartment complex. And it's not about the money. I just want to buy an apartment complex because I used to work there. And it's just, I can refi 3 or 4 houses and I can get at least 800,000 with 70%. And 800 will be okay, but I want to refi with that Jonathan and Sergio, so that way they can guide me through all these things, because it's amazing. The numbers you just put in, just like, I mean, I had to take my chair really, really strong because you blow me away from my chair.
And one of the reasons I created the calculator, because usually people cannot imagine that, cannot imagine the compounding, cannot imagine the accumulation that happens. And most people have not even done that calculation because, yes, like, right, 100,000 to 1.2 million seems kind of like unbelievable, but usually it's accomplishable. But unless you go and sit down and do the math, you will never know that.
I mean, it's just my initial investment is 100. It was 150. I know it's 2 point something.
Yeah,
it's crazy. I mean, I never done all these numbers, and it's just like, oh my gosh, blew me away. You blew me away today. I was excited.
I think that a lot of people hate numbers. I will highly encourage you, for you, though, Sergio, specifically, sit down and do some numbers. Because actually, if you have multiple properties, there are certain things like portfolio loans where you don't have to go and refinance each house at the same time. There are lenders that do those, where if you want to go the refinance route and still keep them, you can go the refinance route in a portfolio loan without going through each individual.
Okay, thank you very much. So hopefully, everybody got a clear what you just said. It just let the number just blow away. It's amazing. Thank you very much.
And don't forget, guys, the recording will be accessible via audio and YouTube. So if tonight just blew your mind, we're gonna be able to go back. You're able to go back and rewatch the recordings. And we also have Prolet's information if you want to reach out to her personally about the book she recommended, and also her investment analyzer that she's got, which I think is just phenomenal. That's just genius, you know. So Prolet, once again, thank you so much for coming tonight to just bring a lot of value to our community. And honestly, I think we need to have you every quarter of the year, to be completely honest. I don't know if you're up for that, to be completely honest. Is that something that you're up to come every quarter? Or
I'm happy to come and share my passive investor perspective.
I love it. I love it. Well, that being said, that really concludes tonight, guys. Thank you so much for coming, and we'll see you next Tuesday.